A lot of people ask questions about stablecoins and whether or not you're taxed when you do transactions with stablecoins. And when you buy a stablecoin, I'm assuming you're buying it for $1 per coin, so that's the cost basis. And then when you sell it or exchange it for another asset, you're exchanging it basically at $1 a coin or token. So in a sense, there is a cost and there is a sale price. Each one is $1, so the gain is $0. So that's how they look at it. Now, there are discussions in Congress about making changes to the tax laws that exchanges of fiat to US dollar stablecoin tokens and back, or US dollar stablecoin tokens for other stablecoin tokens that are dollar denominated, that these would allow you to not have to report this on your tax return. But hey, even if you did, you report the total amount and it's zero gain. It's just an administrative hassle. There's no tax on the transactions you have with stablecoins. What is cost basis? We use this word all the time in taxes, but it's worth taking a second and thinking about what it means. When you buy something, we typically call that the cost. And then when you sell it, that's what you sold it for, the proceeds, the difference your gain. Hopefully it's a gain, maybe it's a loss. What is cost? Well, in accounting terms, we like to use the word basis, which is a slightly different meaning than the word cost. But it basically is what you paid for it, the cost, plus the transaction fee that you paid to do that transaction. And if we were talking about houses or other sort of things, any improvements that might have happened on it, all that goes into what we call basis. We tend to use the phrase cost basis because people get thrown off by the word basis. So cost basis and basis are the same thing. Often you may hear the phrase adjusted cost basis. And that's, again, your cost basis plus any changes that went onto it, the adjusted cost basis. All of it is the overall picture of what you paid to get the asset. That's what cost basis is. One of the most common questions we get is, if I move coins or assets from one wallet to another wallet, both wallets being my wallet, is that taxable? And the answer is no. The reason is, here's the key, there's no change of ownership. You own both wallets. It's just you changed which place it was located. It's still yours. And that's the key. Now, if wallet you transferred to was somebody else's wallet, then that transfer is actually a change of ownership and it would be effectively treated as a sale to the other person. I will say this, it's very important to keep all your records of your transfers as much as possible. Keep records of everything. When you're doing your taxes, if you didn't sell any cryptocurrencies or you did not exchange one cryptocurrency for another cryptocurrency, then you don't have any specific sale or gain items that you have to report on your taxes. You don't have to report anything on your taxes. You should still check the box that says that you had dealings with digital assets on front page of the 1040, but there's nothing to report. You don't have to report buys, you don't have to report transfers of your cryptocurrencies, but anytime you exchange one for another or actually sell into fiat, then you need to report that. If it's been a bad year for you and you lost money trading, do you have to report that in your taxes? Well, yes, because the silver lining of losses is that you can reduce your taxes by the amount of the losses. Let me tell you how it works. So let's say in a particular year you had 10,000 worth of gains on various trades, but you also had $15,000 worth of losses in a particular year. So the way taxes work is you add those together, and it turns out that you have a net negative $5,000 or a $5,000 loss. So the losses offset your gains so that you're not taxed on it. Now, there is a limitation. If at the end of the year your net loss is more than $3,000, then you're limited by tax law to only writing off $3,000 on your current income tax return. Let me tell you about that. $3,000, it reduces your adjusted gross income, your taxable income, by $3,000. So you're going to be taxed on less money. So that could save you a lot. In the situation where your losses are greater than this $3,000 limit, then the excess, in our example, $2,000 excess loss, is written over on what's called the capital loss carryover worksheet. And you record the fact that you had $2,000 of loss that you didn't use. Now, what will happen then is that amount you save for the next year. And then if the next year you have more gains than losses, you can throw in this capital loss carryover and reduce those gains even further. So although you can't use all the loss in the same year often, you can use it in the future and can last indefinitely to offset any future gains. So always, always, always report your losses. I can tell you a story. I had a client one year called me up and said, Clinton, I have a situation. 2 years ago, I lost $600,000 trading cryptocurrency. I didn't report it on my taxes because I didn't want my wife to know about it. He was a doctor. He had a lot of money. Then he said, the next year, I lost $400,000 on my taxes, and I didn't tell my wife about it. Now, this particular year happened to be year 2020. He said, this year, I made $1 million, and I don't want to have to pay taxes on $1 million. My wife will get mad at me. I said, I got great news for you. We're going to go back, amend your tax returns, report those losses that you hadn't reported. You'll have $1 million. Well, there'll be a write-off of $3,000 for each year, but the rest of it, which would be $997,000, is now a capital loss carryover, and it's going to offset that $1 million gain you had. You're only going to pay taxes on the $6,000. So this is a beautiful thing. So always, always, always keep track of your losses and report them. There's no downside to reporting losses.